Welcome to another episode of the Washington State Retirement Planning Podcast. I'm your host, Ethan Meikle, and here we specialize in helping Washington State employees get a better understanding of how their amazing benefits work and the best ways to utilize them. Today we're going to do something a little bit different on the show. I'm actually going to show an excerpt of a presentation that I did about all the Washington State retirement benefits. So right around time of COVID or so, I started doing live broadcasts where I'd go through all of the Washington State benefits, so going over pensions, 403s and such, in one clean presentation. I did this for a lot of different school districts. Once COVID happened and I couldn't get in there in person anymore, I switched to digital and I created these presentations. I used to do these live for a bit, even did this for new hire seminar. So when the new staff of a school district is coming in, they're trying to train their employees in their benefits, I would come in and give this exact presentation on it. So I'm going to drop it in here today so you can get a better understanding of all of the basics that go on with the plans. About 90% of the questions that we get can be answered from this one session that you're going to hear here today. So unless you like digging around or spending money, doing one-on-one sessions, this is probably going to help you out, at least for the basics of it. And while there are a lot of technical questions that do require expertise on it, oftentimes when people are planning on their own, they overlook just the basics, and that's what trips them up. So today we're going to go through all of that. So I got no question of the day today. This session is going to take the majority of our time here on the podcast. So hopefully you guys enjoy it. Now, one quick note before we get into it is just understand that because this is a little bit older, some of the numbers you're going to hear aren't current. So I'm going to say, max contribution is something like $26,000. We know it's not that anymore. So just keep that in mind as you go through this. Also, back when I recorded this, there were still RMD requirements on Roth 403B accounts, which sounds odd, but it used to be a rule. That changed recently. So Roth 403 accounts no longer have required minimum distributions on them. So just keep that in mind as we go through this today. Now let's get into it. Today, we're really just going to go over your retirement benefits in this breakdown. So today, just 4 topics we're going to cover. First and foremost is how your plans actually work. So we're going to cover how Plan 2 and Plan 3 works. Second, we're going to look at 4 ways to save for the future. So these are ways you can save outside of your pension plan. The third thing we're going to touch on is what you should never do when it comes to investing. And last but not least is a tax trap that I see about 90% of educators fall into. But before we get going, just a quick introduction. So I'm Ethan Meikle, and my business partner is Shreen Sharma. We're the founders of Scenic Financial, and we're endorsed by the NEA as a retirement benefits specialist for Yakima County. So we are self-employed, independent advisors. And what that means is we call our own shots, and we're not tied to any company. So we can be on your side when it comes to making decisions. Our focus is really just helping people reduce market risk, get out of high fees, and build more tax-efficient futures. And we really just try to take these complicated things, present them in a simple way that everybody can understand, and we can make decisions together. All right, so let's start going. So on Plan 2, it's going to work something like this. You're going to get 2% for every year that you work in Washington State, and that total percentage is going to be based on the average of your top 5 years of income. Now, something to note here, it says top 5 years of income. This is not your last 5 years of income. So while most people, it is going to be the last 5, if you ever find yourself working part-time or took some time off towards the end of your career, it's not going to ding you because they're going to go off your top 5 years of income. And when they say income, it's all income, not just your base salary. So if you have national boards or you're a coach, any and all income, no matter what school district it comes from, will count when they do this average. Over here where it says years worked, this is full-time years worked in the state of Washington. If you worked in a different state, those years working would count towards their state's pension plan, not the one in Washington. And to earn a full service credit, you have to work a certain number of hours per month to get credit for that month. The easiest way to check is just if you log into your DRS account, you should be able to pull up a detailed history of your service credits. So when it's years worked, they're really talking about your service credits here. I got a couple of questions about how the maximum works. There is no maximum for this. So if you work 30 years in this plan, you're going to get 60%. If you want to work 40 years, there's 40%. They don't cap the number of years that you work. And you can start collecting your full benefits at age 62 with 30 years of service, or at age 65 if you have less than 30 years of service. So for those of you that actually have 30 years of service, your full benefit age starts at 62. Now, this doesn't mean you have to work until 62. You can retire whenever you want to. As long as you don't draw your benefits, you're not going to get penalized for it. Same if 65 is your full benefit age. As long as you're not drawing it before that age, there's going to be no penalties. If you were to draw it before age 62 and you have at least 30 years, the penalty is going to be a lot smaller than if you had less than 30 years here. So in some cases, people that have 30 years can actually collect at 61 or 60 and end up making more money over the course of their lifetime. So one thing to note though is that if anyone that's hired after May 1st of 2013, their full benefit age is going to be 65, regardless of the number of years worked. So it doesn't matter how many years worked, you have to go to 65 no matter what. Now this may change, but as it stands today, that's the way it is. A couple other things you want to know about this plan is it has a cost of living adjustment built into it. So this only applies once you start collecting the pension, but each and every July, they're going to take a vote on whether or not to give you a raise. And the raise will be anywhere from 0 to 3%, just depends on what legislature votes on in that given year. Another thing to know is you're going to have 4 different survivorship options. Again, nothing you have to worry about until you actually go to apply to collect your benefits. If you're single when you go to collect, you're going to use the full formula, which is this bold one here on the top. This is what they call option 1. Anyone that has a spouse, you can choose to take a survivorship option. And what that is you're going to take a reduced pension. And if something were to happen to you, a portion of that pension would continue on for the rest of your spouse's life. Now, how much of the reduction depends on which option you take and if there's an age difference between you and your spouse. If you want more complete calculations on that, you can always contact the state for those options, or you can set up a meeting with us and we can walk you through it as well. Right? So in a nutshell, that's basically how Plan 2 works. If you ever see a statement that says how much you've contributed into it, that really doesn't matter in your case because your pension is strictly based off this formula, not how much you pay into it. Right now, if you look under your pay stub, under your deductions, you're going to see a number in there. It's about 7% of your income is being taken to pay for this. But again, it's all based off of this formula, not how much you put into it. Okay, so now we'll just move on to Plan 3. So with Plan 3, there's actually 2 parts to it. You have your defined benefit, which is the pension. And just like we saw in Plan 2, it's just the same formula. The only difference here is you're only going to get 1% for every year you work. So everything else stays the same. Your service credits are earned for full-time employment. It's average of your top 5, not your last 5. And it's based off all your income. And you can collect it at the same ages, 62 with 30 years and 65 if you have less than 30 years. And you still have to go to 65 if you're hired after May 1st of 2013. And you still have the same cost of living adjustments and the same survivorship options. Really, the only difference is you get 1% per year. And rather than paying money into this pension plan, your contributions simply go into your defined contribution side. So if you look at your defined contribution, this is where your money goes. Right now, you're going to save somewhere between 5 to 15% of your income every month into this plan. How much you're doing simply depends on what you chose when you started your school district. Now, the way it currently stands, you can't change how much you contribute unless you change employers. So if you go and change school districts, that's when you're going to give the opportunity to make a change. And you have a 90-day window to do that. So as long as you're in your current school district, whatever your current contribution rate is, it's locked in. So where that money goes is simply into an investment account, and it's going to rise and fall with the market. Some important things to know about this is that all the money in this plan is absolutely hands off until you separate service. So it doesn't matter how old you are, it doesn't matter if you have a hardship or you want to take a loan from it, there's absolutely no access as long as you're an employee of the state. So it's illiquid. However, as soon as you separate service, no matter what age, you now have access to the money. You can do whatever you want with it. The other thing to know about this is all the money in here are pre-tax. So when you make a pre-tax contribution, it does give you a tax deduction today, but any money you go to withdraw from it will be taxed at that time. Plus any interest growth you got will also be taxed. This account is fully taxable in the future. If you want to draw this money before age 55, you're going to also incur a 10% penalty on top of that. If you're 55 or older when touching the money, then you just have to pay your taxes. There's no penalty. So as far as the investments go, that's really the only control you have here is how your money is going to be invested. So the default fund, this fund that they just throw you into, if you were employed before July 22nd of 2011, you're going to be put in the WSIB fund, also sometimes called the TAP fund. And the thing to know about this is that it's aggressive. It doesn't matter how old you are, it's just an aggressive account. So it's going to do really well in the market as well. But when the market takes a turn for the worse, this one's going to follow suit. So if you're within 5 years of retirement, you may want to start moving out of this plan to something a little more conservative to help protect your money. Now, for those people that are more recent hires, you actually got put into something called a target date fund. And what your target date fund does is it looks at when you're going to turn age 65, and it's going to set an investment allocation for you. And as time goes by, it's going to automatically make you more and more conservative. So this one will adjust for you, unlike this WSIB fund. So this is not a bad place to be. Now, you also have the option to become self-directed. So for those of you that were lucky enough to get into the target date fund, you're already self-directed, but there's also 7 other funds available. So if you want to invest, whether you want to be on the aggressive side or on the conservative end of things, you have a few different options to invest in as well. If you're in the WSIB, you can move over to the self-directed at any time you want to. You just have to make a call over to the state and tell them that's what you want to do, and they'll transfer the funds for you. A couple of things to know about this is any money in the WSIB is pretty illiquid. So even if you separate service and you want to take some money off of it or transfer it to somewhere else, it takes them almost 2 months to cut that check. So they're really slow on it. Usually what I recommend for people getting close to retirement is get out of the WSIB and put yourself into self-directed, just so when you want money, you can get your check within a week instead of 2 months. So that's basically how the Plan 3 works in a nutshell. So now if we look at a graph and sort of like timeline of how all of this plays out, if you have your age on this axis and your income up here, as you work, your income should steadily increase over time. And then you're going to get to a certain point in life, 62 or 65, where you want to retire. And then you're going to start collecting your pension. On top of that, here in Washington, you guys also contribute to Social Security. So you're beginning a Social Security income as well. So you have 2 sources of guaranteed income for the rest of your life, just for being a state employee. So you see that there is a drop here. So your income will take a small hit. But because a large chunk of your income is being made up of guaranteed sources, this drop isn't as severe as people without pensions would see. So even though you may make a little bit less income in the future, oftentimes it's not enough to change the tax bracket. Now this gap up here is something we call your shortfall. And the way we make up for your shortfall is through saving in different retirement vehicles. So for people in Plan 3, that's your defined contribution plan comes into. It's used to help make up for any shortfall or any extra money you need to live on. There's other ways to save as well. And there's things like the DCP, a 403B, or Roth IRAs. They're all popular options that people use to help make up this gap. One thing to also know is these pensions weren't designed to replace your own income. And that's why your school district sponsors different plans to help you make up for their shortfall. So now let's just break down the different options you have for your district. So the first one you guys have is the DCP, also known as Deferred Comp. So a couple things to know about this plan is it's basically the same exact investments as Plan 3. So if you're on Plan 3 and you have a DCP, you're really just putting more money in the same place. The only difference is this one's going to be flexible. So this one you can start, stop, increase or decrease your contribution at any time, any given month. Like Plan 3, there's absolutely no access to it until you separate service. So it's pretty hands-off as well. The one key benefit that a lot of people like with it is there's no 10% penalty, but this only applies if you plan to retire and withdraw funds before the age of 55. So if you're gonna retire after age 55, this really doesn't mean much to you. There's also no income limits when using a DCP, so it doesn't matter what your household income is, you can always use it. The contributions are gonna be pre-tax only, so you can only save on a pre-tax basis. I already went over the same investments as Plan 3. There's no professional oversight. So this is being managed by the state, but there's no financial advisor licensed by the state able to give advice, but they still charge fees for it. So it's always important to work with somebody that can look into your plan and help you pick and choose investments. As far as your contribution limits go, it's up to $19,500 for 2020 for people under 50. Once you hit age 50, you can actually contribute up to $26,000 per year. The second popular option is the Roth IRA. So IRA just stands for Individual Retirement Account. So anybody can set one of these up. It's not going to go through your employer. So this is a private account. So just like the DCP, it's flexible in that you can change your contributions at any time. You have full access at the age of 59 and a half. Now this only applies to your interest growth. Whatever you contribute can be touched at any time for any reason. And unlike the DCP, this uses after-tax contributions. So you're paying your taxes on the money today, and any growth you get will be tax-free. This one does have income limitations though. So if you're married and you make over 196 as a household, or you're single and make over 124, you can't actually use a Roth IRA anymore, or at least not reap the tax-free growth from it. Now the contribution limits in this one is a lot lower. It's only $6,000 a year for people under 50. For everyone over 50, it's $7,000 a year. It does have a wide range of investment choices though. So you can really branch out and diversify here. The reason it has an asterisk, it's really going to depend on what institution you use to set up your Roth IRA. If you're using a bank or certain investment companies out there, they kind of limit their staff to what they can use, and you may not be seeing the full scope of what's out there. The next thing you guys have is something called the 403B. Some people refer to it as a TSA, right? Tax shelter annuity. Now, these are your version of a 401k plan. It's sponsored by your school district, and you're able to start, stop, increase, decrease anytime you want to. So it's flexible. Because it's sponsored by your school district, all you do is fill out a form and turn it into payroll to make those changes. It also comes off your paycheck automatically. So it's a way to set something up and just set it up and forget it. So the limits are going to be the same as we saw in the DCP, $19,500 a year if you're under 50, $26,000 if you're over the age of 50. This one also has no income limits, so you can always use it no matter what. As far as access in this account goes, similar to Plan 3, you have access to this at age 55 if you're separated. Otherwise, age 59 and a half. So what that means is even if you're still employed and you're 59 and a half or 60 or 62, you can actually access money within your account. So unlike the other ones we saw where your money's hands off, you have access to it while you're still employed. Now, before age 59 and a half, you can touch your money through one of two ways, either through loans or hardship withdrawals. So loan is exactly like it sounds. You're going to loan or borrow your own money from your account, and you're just going to pay yourself back. Now, there is an interest charge, but the unique thing with 403Bs is that interest charge goes back into your account. It doesn't go into any other company's pocket. So you're paying yourself back your own money plus interest. And these loans need to be paid back within 5 years, and they can be used for any reason you need to. Because you're paying back interest to yourself, they're a very low-cost loan, and they can be a really good tool for paying down high-interest debt. One thing to know, though, is you have to make sure your school district actually allows for loans. Most school districts do, but there are some that haven't approved it yet. So make sure you check on that before you plan to take a loan. The second way is the hardship withdrawal, and that's just the federal government giving you a couple of different ways to take your money out. So if you incur things like medical bills or you need a down payment on primary residence, you can take the money out, you'll pay your taxes if taxes are due on it, and you don't pay it back. So as far as taxes work, you can contribute either on a pre-tax basis or a Roth basis, and everything's going to grow tax deferred. So if you have a pre-tax contribution, it works just like your other accounts. If you contribute as a Roth, this now becomes a Roth 403B or Roth TSA, and you have all the benefits that go along with the Roth IRA just on steroids. So when you use a Roth 403B, there's no income limits, and you can use these higher contribution limits. You can put much more away using a Roth 403B than you would a traditional Roth IRA. As far as investments go, you're going to have a wide range of them, but again, it's going to depend on the company you choose to work with, as some of them could limit what they're allowed to use, but you have the full scope available from conservative to aggressive or anywhere in between. You can also change your investments at any time. And just like anything else, there's no guarantees. The money's going to go up and down depending on what the market does. So one thing I'll caution you though, is some of you guys may have 403Bs already, or if you think about getting one, is that not all 403Bs are really equal. And what I mean by that is there are actually two different types. There's annuity-based 403Bs, that's where the TSA name comes from, and there's just investment-based ones, and there's some key differences between them. So TSAs are going to be issued by insurance companies, and they're going to come with a surrender schedule. And a surrender schedule is a period of time where your money has to stay there. And if you want to touch your money during that time frame, you're going to have to pay a penalty. Not only that, there's oftentimes you'll see a rolling surrender charge. So what that means is every time you make a new contribution, that contribution gets its own set of a surrender schedule to it. So you put $100 in 1 month and you have a 5-year surrender, that month's contribution has to stay there for 5 years. When you contribute again the next month, that monthly contribution has to stay there for another 5 years. So it just rolls on and on and on. Another thing to know is you're going to have limited fund selection. It's whatever these insurance companies approve that you're allowed to use. Oftentimes they make up their own funds and keep their own funds in the fund list. You don't have the best selection. So there could be funds out there that may be cheaper or be performing better, but you don't have that option. Now, when it comes to fees, on average, you're going to see these things charged between 2 to 3%, which is pretty high. And when I say total fees, it's including all the fund expenses plus the different costs associated with insurance companies. One thing to be careful of is sometimes people will say this is a no fee one or a guaranteed 403B contract. When they say no fees, there's always a catch. So sometimes they'll cap your growth. So it'd be invested, but they'll cap your growth at say 3% in a given year. That's how they make it free, because they're going to take any gains you get past that. And more often than not, the market's going to do better than 3%. Sometimes they'll just guarantee no losses, but they'll only give you a 1% rate of return to maybe 3% on a guaranteed basis. And when you account for inflation, that really doesn't do a whole lot for you. When we have investment-based 403B contracts, these sometimes can be issued by insurance companies, but more often you're going to find it from different financial firms. The key difference to this one is there are no surrender charges. So your money's not locked up or required to stay with that certain company or carrier for any period of time. And then you have the biggest range of funds here, usually thousands and thousands of options. So you have your best bet of getting low cost funds in this type of plan. And your total fees will be a little bit lower on average. On the low end, you'll see 1.5%. On the higher end, it'll be closer to 2.5%. So the way the fees work in this one is you're going to have the fund expenses here. The financial firm usually has a small fee as well. And the advisor actually charges their own fee. So the reason for the range really depends on how much the advisor charges. Keep in mind that certain companies out there that have their own employees work for them will maybe require them to charge a higher fee than you would see elsewhere. So these are really the two choices you guys have available to you. So I would recommend staying out of these guys just for the liquidity of it, and also saving money in the long run, and use one of these different types of 403Bs. So now we're just going to do a quick comparison of the different things on one sheet so you can kind of see the pros and cons of each of them. So when you look at flexible contributions, that's something all these accounts have in common. When we're looking for something that has no income limits, the DCP has no income limits, only that Roth IRA does. When you look for contribution limits, all of these have certain limits that you can use. If you're trying to find something that has tax-free growth, only the Roth accounts are able to do that for you. Now there's going to come a time where you're going to be required to pull money out of your accounts. And this is what they call the RMD, the required minimum distribution. Now this only affects accounts that have pre-tax money in them. So it's going to affect things like your DCP and your 403B. The Roth accounts don't have this. So you're never going to be forced to touch your money if you don't want to. Now keep in mind that a Roth 403B actually doesn't get this treatment because it's really just a Roth IRA in the 403B shell. So really the easy way around this is just to move your Roth 403B into a Roth IRA before you hit age 72, and the problem is avoided. As far as access goes, you can't touch your DCP while you're employed, but you do have access to your Roth IRA, 403B, and Roth 403B while you're employed. And when it comes to inheritance, so once your beneficiaries get your money, the DCP, because it's pre-tax, they're going to be responsible for that tax bill as well, whereas the Roth accounts will not. One thing to know is that what I've shown here is just the ones you can use through your school district or the more common ways to save privately. There are other alternatives that aren't as well known. You do have to qualify to be able to use them, but they're really good for people that don't have a Roth 403B option in their school district, or maybe they make too much for a Roth IRA, or if they want to contribute way more than what the limit is here, these Roth alternatives may be for you. All right, so as we've just seen that there's a pretty big difference between pre-tax saving and Roth savings. This is where we get into that tax trap question that I mentioned in the beginning. So the whole premise of saving pre-tax is we're going to contribute money each month. We'll get a small tax deduction, but in the future, everything is going to be taxable here. Whereas on the Roth side, you're going to pay taxes on your contributions today, and any future growth you get will be tax-free. So you have to ask yourself, is it really worth taking a small deduction on the small amount of money I'm putting away today, only to have to pay taxes on the entire thing in the future? Now, when money's saved pre-tax, you're going to have things like RMDs come at you, but it's also subject to any regulatory changes. So if taxes were to increase in the future, you're going to basically be forced to pay those higher tax rates. So it's something to keep in mind when you're choosing this to save money on a pre-tax basis or a Roth basis. So now let's dive into it a little bit further. When pre-tax accounts, all withdrawals are taxed. So every single penny, whether it's a capital gain, a dividend, any interest, every single penny will be taxed by you when you go to pull it out, and you're going to be forced to touch it. So the IRS requires you to touch it at a certain age. Now recently they pushed age back to 72, but they can also change it and make it back to a different age if they want to. So when you have money in pre-tax, you also have to watch for this. As I mentioned earlier, you're going to be fully exposed to any tax law changes. So if you look at the state of the economy and our national debt, as our clock keeps going up and up and up, there's only one way for the government to stop our debt from climbing too high, and it's taxes, right? It's the only stream of income that government receives. So if they want to start curbing that, they're going to have to change taxes. And if you don't want to be exposed to any kind of tax law increases in the future, that's where things like Roth or any kind of tax-free savings comes into play. And fourth is your beneficiaries still have to pay the taxes on their account. So if you have a Plan 3 with, say, $300,000 in it, and your kid inherits it, they have to pay those taxes on that $300,000 still. Not only that, they have to pay them within 10 years. So that $300,000 has to be basically drained within 10 years. So they're going to have to pull out a little over $30,000 a year, which is going to create a huge tax trap for them as well. And this slide really just talks more about the RMDs. Basically, it's going to start age 72 and it'll last for a lifetime. And it increases every single year. And if you decide not to take it, you forget about it, or just take out the wrong amount, they're going to slap you with a 50% penalty on that. It's one of the worst penalties in the tax code. And because the RMDs require you to touch it out, you have to pay taxes at whatever rates are at that time, and your beneficiaries will also have to pay it. All right, so this one has a little bit more numbers on it. This is just a sample income breakdown that I run for clients. So this is just someone working, earning $100,000 a year. Their spouse is retired, collecting about $2,000 a month from Social Security, so their income is about $124,000. Now they're going to work until they hit their full retirement age at 62 in this case, and you'll see their income drop. This person elected to hold off on Social Security the next year, so that's where we see the income come back on. So we go from $125,000 to $77,000. they're going to drop a bracket in this case, but over time, once they hit those RMD ages around 70, that's when you see this column fill in. So in this case, she's required to take out $26,000 off her account, which in this case, she had about $680,000, because you got to keep in mind, even though you're retiring here at 62, your money's still going to grow for the next 5 or 10 years, and it may be higher in the future and require a bigger withdrawal amount. So you see your income went from 86,000 this year all the way up to 114,000 this year, and it keeps increasing year over year. And this is going to bump them up into another tax bracket and force them to pay these taxes at a higher rate, right? So that's really the tax trap you guys need to be aware of. Okay, so here's just a simple calculator. And this is where I'm going to talk about the point where I said on the one thing you should never forget about when you're investing money. So in this example, we have $300,000 growing at a 5% rate of return. We're going to assume a fee of 2% and tax rate of 22%. We're just going to do it for 15 years. So this first column here is the gross. This is simply money growing without any taxes or without any fees. If you were able to invest money without any of those things, this is how it'd look if it could earn 5% a year. So over 15 years, it could grow up to $623,000. But as sure as you guys know, that's not the case. Whenever we're investing money, we have to pay a fee of some sort to somebody. So if we include a fee of 2% to that, we can quickly see that over 15 years, you paid $116,000 in fees, and you don't get $623, you only get about $460,000. So fees can take a pretty big bite over time out of your account. So when you're having money invested with an advisor or an institution, you always want to make sure you don't overlook the fees. I mean, even a 0.1% difference can make a huge impact in the long run, right? So if we show 2% here and we just change it to 2.1, that 0.1 add another $5,000 coming out of your account. So fees are something you don't want to take lightly. The other thing to know is that if this money is in a pre-tax account, any interest you earn hasn't been taxed yet. So you have to think that even though I earned $15,000, I still have to owe my taxes. And if I'm at the 22% bracket, that's going to be about $3,300, right? So over the long run, this is how taxes affect you. So even though you may be earning good money or getting a decent rate of return, you have to take in mind that that rate of return is still pre-tax. You haven't paid tax on that money yet. And if taxes were to increase, that rate of return will go down and you're going to owe more money. So if we just total everything up, you see that over the long run, this only works out to be about $414,000, and you spent $140,000 between taxes and fees. So this is something you guys need to take into account for when you're going about your investments. That pretty much concludes it. And with that, thanks guys for watching. If you guys do have any questions, just feel free to email me. I'll answer them then. You guys have a great rest of your afternoon. Bye guys. All right, before I sign off, just a real quick legal disclosure that we're required to say as licensed fiduciary advisors. So remember that this is a podcast. It is designed for educational and entertainment purposes only. I don't know you personally, therefore I cannot give you any personal advice. So please don't take anything that we say on the show as being personal, financial, legal, or tax advice. If you want that kind of stuff, make sure you seek out a professional so they can help you with the strategies and investments that are right for you. Also, please remember that despite the name of our show, we are in no way associated with Washington State or the Department of Finance Systems or any other Washington employer. We're a private-owned firm that specializes in working with Washington State employees, which is why we know so much about this stuff. So remember, we don't work for the state in any way, shape, or form. So please don't confuse us as being an official representative of the state. All right, that's it for the legal stuff. I'll catch you guys all next time.